You are watching history unfold, but most of you are looking at the wrong things. You are watching stock prices hit nominal highs while the currency those stocks are denominated in is quietly burning to the ground. What we are seeing in early 2026 is not a standard economic fluctuation. It is the end of a long-term debt cycle. The United States government is currently borrowing money to pay the interest on money it already borrowed. The deficit is projected to hit $1.7 trillion this fiscal year, and the total national debt is nearing $38 trillion. When a reserve currency empire enters this phase, where it must print money to survive, it signals the final stage of the big cycle. The paradigm is shifting, and if you are holding cash or long-term U.S. bonds, you are effectively standing on the tracks of a runaway train. I have spent the last 50 years studying the cause-effect relationships that drive economies and markets. In 2008, I saw a crisis coming that others missed because I wasn't looking at what was happening just in that moment. I was looking at history. I studied the deleveraging of the 1930s, the post-war shifts, and the fall of the British pound. Because my firm Bridgewater understood the mechanics of the credit cycle, we didn't just survive the 2008 crash, we profited from it. We understood that when debt service payments overwhelm income, the system breaks. Today, the warning lights are flashing red again, but this time it is not just a housing bubble. It is a sovereign debt crisis combined with a geopolitical power shift. This is the 1930s to 1945 period all over again. If you want to understand these cycles to protect your wealth and profit from the coming crash or the next big win, you need to subscribe to Economic Principles right now. Let's look at the mechanics of what is happening. The economy is a machine. It works in a relatively simple mechanical way, but most people don't understand it, which leads to them getting hurt. Right now, we are dealing with three major forces that are converging to create a perfect storm. These are forces that haven't happened together in our lifetimes, but they have happened many times in history. The first force is the long-term debt cycle. You have the short-term cycle, which lasts about 5 to 8 years. That's what the Federal Reserve tries to manage with interest rates. We saw them cut rates recently to the 3.5% range, trying to stimulate growth. But we are also at the end of the long-term cycle, which lasts 75 to 100 years. This happens when central banks lose their effectiveness. Interest rates are already low relative to inflation, and printing money becomes the only option. In 2025, we saw the US dollar lose significant value against gold and hard assets. Why? Because the supply of dollars is increasing to pay for debts that can never be paid back with hard money. They can only be paid back with depreciated money. When you hold a bond, you are holding a promise to receive currency in the future. But if the government has to print the currency to pay you back, you are getting paid in money that buys less. This is a hidden tax. We are seeing a massive shift away from American assets by foreign central banks. They are buying gold. They are buying commodities. They are acting rationally because they see the balance sheet of the United States. We are running huge deficits during a time of relative peace and growth. That is unheard of. It means there is no buffer for the next downturn. The second force is internal disorder. This is the social and political conflict caused by the largest wealth and value gaps since the 1930s. When you have large wealth gaps and the economy turns down, the people start fighting. We are seeing this polarization in the United States right now. The political center is collapsing. You have populism rising on the right and on the left. This creates a dangerous feedback loop. The wealthy move their money out of the country or into safe havens because they fear higher taxes or confiscation. The working class demands more support, which leads to more government spending, more debt, and more money printing. This cycle of internal conflict weakens the nation and makes it vulnerable to external challenges. This leads us to the third and perhaps most critical force, the rise of a great power to challenge the existing power. This is the external conflict. For the last century, the U.S. has been the dominant world empire, and the dollar has been the world's reserve currency. This gave the U.S. an exorbitant privilege. We could print the world's money, but China has risen. The BRICS alliance, now expanded to include major oil producers like the UAE and Iran, is actively building an alternative financial infrastructure. They are trading in local currencies. They are hoarding gold. They are building payment systems that bypass the US dollar. This brings us to the concept of the Thucydides trap. When a rising power challenges a ruling power, war, economic or military, is the usual result. We are already in an economic war. We are seeing tariffs, technology sanctions, and capital controls. The new order we are entering is one where the world splits into two spheres of influence, an American sphere and a Chinese sphere. In this environment, the US dollar loses its monopoly. If the dollar loses its status as the sole reserve currency, the demand for US debt collapses. And if nobody wants to buy our debt, the Federal Reserve has to buy it. That means printing money on a scale you have never seen before. So, where are we in the big cycle? We are in the late stage. The classic signs are all there: excessive debt, internal political polarization, and the rise of a rival power. The period from 1930 to 1945 is the best analog. We had a debt crisis, followed by money printing, followed by internal revolution and external war. I am not saying World War III is inevitable, but the probabilities are higher than they have been in our lifetime. What does this mean for you and your money? It means the strategies that worked for the last 40 years, like the 60-40 stock and bond portfolio, will not work in the future. Cash is trash. It is a depreciating asset. Bonds are return-free risk. You are lending money to a government that is debasing the currency to pay you back. You need to diversify. You need to own things that are real. Gold is not an investment. It is money. It is the only financial asset that is not someone else's liability. When the system resets, gold is the anchor. You also need to look at international diversification. Don't have all your eggs in one basket, and definitely don't have them all in one currency. The world is changing. The order is changing. If you don't adapt your portfolio to this new reality, you will be left behind with paper promises that are worth a fraction of what you think. This is not about being a pessimist. It is about being a realist. It is about looking at the mechanics of the machine and understanding that if you keep printing money, the value of that money goes down. History has shown this thousands of times. It happened to the Romans, it happened to the Dutch, it happened to the British, and it is happening to us. The next step for you is to assess your own exposure. Look at your portfolio. How much of it is in US dollars? How much is in nominal bonds? How much is in assets that will do well in an inflationary, conflict-driven environment? If the answer scares you, it should. But knowledge is power. By understanding these cycles, you can prepare. I will continue to update you on these indicators as they evolve. The situation is moving fast. The deficit numbers, the inflation data, and the geopolitical moves are changing by the week. You need to stay informed. Let's go deeper into the mechanics of why the currency is crashing, because this is the most difficult concept for people to grasp. Most people think of money as something fixed, like a ruler that measures value, but money is not fixed. It is elastic. When the government spends more than it takes in and it cannot raise taxes because that is politically impossible, and it cannot borrow from the free market because interest rates would rise too high and crush the economy, it has only one door left open. It must print. This is not a political opinion. It is a mechanical reality. In 2026, we are seeing the Federal Reserve essentially acting as the buyer of last resort for U.S. Treasury bonds. When they buy the debt, they pay for it with newly created digital dollars. This increases the supply of money. When the supply of money goes up faster than the supply of goods and services, the value of that money goes down. You experience this as inflation. You see the price of groceries, gas, and housing going up, and you think those things are becoming more expensive, but that is the wrong way to look at it. Those things are relatively stable in value. It is your money that is becoming worth less. To understand where this goes next, we must look strictly at the 1930s to 1945 period. This is the template. In 1933, President Roosevelt devalued the dollar against gold to break the deflationary depression. It worked to stimulate the economy, but it transferred wealth from creditors to debtors. Today we are seeing a similar dynamic, but it is happening globally. We are entering a phase of competitive devaluations. The United States wants a weaker dollar to reduce the real value of its debt and to make its exports more competitive. China wants a weaker currency to offset tariffs. Europe is printing to keep its social safety nets afloat. When every major country tries to devalue its currency at the same time, the only things that go up in price are the things that cannot be printed. This is why you are seeing gold, silver, land, and Bitcoin reaching new highs while the purchasing power of the wage earner collapses. This is the mechanical process of a currency war, and it usually precedes a trade war, which usually precedes a shooting war. We need to analyze the current productivity crisis because this is the engine of the economy. In the long run, your standard of living is determined by your productivity, how much you can produce in an hour of work. For the last 40 years, globalization allowed us to import productivity from cheaper markets. That era is over. Under the current new order of protectionism, tariffs, and onshoring, we are making a conscious choice to be less efficient in exchange for being more secure. Tariffs are taxes. When you put up barriers, costs go up. Productivity goes down. We are seeing a structural shift from a deflationary globalized world to an inflationary localized world. This means that the inflation we are seeing now is not transitory. It is structural. It is baked into the cake of the new geopolitical reality. The central banks are trapping themselves. If they raise interest rates to fight this inflation, they will bankrupt the government and the housing market. If they lower rates to save the market, they will accelerate the destruction of the currency. Historically, when faced with this choice, policymakers always choose inflation. It is the path of least resistance. Let me explain the concept of the beautiful deleveraging versus what we are experiencing now. A beautiful deleveraging happens when policymakers balance the deflationary forces of debt defaults with the inflationary forces of money printing, so the economy grows while debt burdens fall. We managed this decently well after 2008. We are not managing it well now. The balance has shifted entirely toward printing. The Trump's New Order or any populist economic agenda, whether from the right or the left, prioritizes immediate relief and national strength over fiscal discipline. This is a characteristic of the internal cycle's stage 5, the Civil War revolution phase. In this stage, the rules of the game change. The independence of the central bank is challenged. We are seeing immense pressure on the Federal Reserve to monetize the debt to fund infrastructure, defense, and entitlement programs. Once the central bank loses its independence and becomes a tool of the executive branch, the currency enters a death spiral. We saw this in the Weimar Republic. We saw this in Latin America repeatedly. We are seeing the early stages of it in the reserve currency of the world. You have to watch the bond market. The bond market is the truth teller. For decades, U.S. Treasuries were considered risk-free assets. But in a world where the government is issuing trillions in new supply while major foreign buyers are stepping away, the price of bonds must fall, which means yields must rise. However, the economy cannot handle high yields, So the Fed must intervene to cap yields. This is called yield curve control. It is what Japan has been doing. It is what the US did in the 1940s. When they peg the rates artificially low, they have to print unlimited money to buy the bonds that the market rejects. This is the moment the dam breaks. This is the moment when the holder of the currency realizes there is no adult in the room. In 2026, we are standing on the precipice of widespread yield curve control. When this is officially announced or implicitly adopted, it is the signal that the bond bubble has burst and the currency devaluation is going vertical. Let's discuss the arc of empire and the education gap. A leading indicator of an empire's decline is a decline in the education and competitiveness of its workforce. We are producing fewer engineers and scientists relative to our competitors in the East. We are spending more on debt service than we are on defense or education. This creates a hollowed-out economy that relies on financial engineering rather than actual engineering. Stock buybacks, speculative bubbles, and government stimulus are masking the fact that the underlying engine of American growth is sputtering. When you look at the rise of the Dutch Empire, the British Empire, and the American Empire, they all followed the same trajectory: productive growth, then leverage, then financialization, then decline. We are deep in the financialization phase, where making money from money is more profitable than making things. This is not sustainable. It eventually corrects, and the correction is always painful. This brings us to the psychological aspect of the market. Cycles are driven by human nature, fear, and greed. Right now, there is a complacency in the West that it can't happen here. We believe the dollar is invincible because it has been for our entire lives. This is recency bias. History teaches us that no currency lasts forever. The British pound lost its reserve status. The Dutch guilder lost its reserve status. The transition is usually marked by a decade of high inflation and geopolitical strife. We are in that transition. The new order is not just a political slogan. It is a description of a world where the US is just one of several major players, not the undisputed hegemon. In this multipolar world, the value of the dollar will revert to its intrinsic value, which, given the debt load, is significantly lower than where it is today. You must stop measuring your wealth in dollars. If your stock portfolio goes up 10%, but the currency devalues by 12%, you have lost purchasing power. You are running on a treadmill that is speeding up. The wealthy understand this. They are moving into assets that track inflation. They are buying productive farmland. They are investing in companies with pricing power that can pass costs on to consumers. They are holding physical gold outside of the banking system. The middle class is getting crushed because they hold their savings in cash and their debt in variable rates. To survive this, you have to think like a central bank. You have to create your own reserve. You have to hedge your own liabilities. The system will not save you. The system is designed to inflate away its own mistakes at your expense. The conflict aspect cannot be ignored. History shows that economic wars often turn into hot wars. We are seeing flare-ups in critical resource zones. The Middle East for energy, Taiwan for semiconductors. These are supply chain choke points. In a fragile global economy, a disruption in one of these areas causes a supply shock that the Federal Reserve cannot fix. They cannot print oil. They cannot print chips. If a war spikes the price of oil to $150 a barrel, we get stagflation, high inflation, and a recession at the same time. This is the worst of all worlds for an investment portfolio. It destroys both stocks and bonds. The only things that survive stagflation are commodities and gold. We are currently one geopolitical misstep away from a massive stagflationary shock, and the markets are not pricing this in. They are priced for perfection in an imperfect world. I want to emphasize the importance of the internal political cycle. In 2026, the polarization is not just noise, it is a structural risk to the currency. When a country is divided, it cannot make difficult decisions. It cannot raise taxes, and it cannot cut spending. It creates a paralysis that leads to more borrowing. The world is watching this. Foreign creditors look at the chaos in Washington and they see risk. They demand a higher premium to hold our debt. This higher premium makes the debt even harder to service, creating a doom loop. We are watching the creditworthiness of the United States deteriorate in real time. The credit rating agencies are behind the curve, as they always are. By the time they downgrade the debt, the market has already moved. You need to be ahead of the curve. You need to look at the balance sheet, not the credit rating. We are approaching the end of this deep dive, but we are nowhere near the end of the crisis. The next 2 years will define the next 20. The decisions made by the Treasury and the Federal Reserve in 2026 will determine if we have a managed decline or a catastrophic collapse. As an investor, you cannot control the outcome, but you can position yourself to survive it. The machine is grinding its gears. The noise is getting louder. Do not let the nominal highs in the stock market fool you. Look at the fundamentals. Look at the debt. Look at the history. The cycle is turning. The next step for you is to assess your own exposure. Look at your portfolio. How much of it is in US dollars? How much is in nominal bonds? How much is in assets that will do well in an inflationary, conflict-driven environment? If the answer scares you, it should. But knowledge is power. By understanding these cycles, you can prepare. I will continue to update you on these indicators as they evolve. The situation is moving fast. The deficit numbers, the inflation data, and the geopolitical moves are changing by the week. You need to stay informed.